through this, Mike.
We had a good thing, you stupid son of a bitch. We had Fring. We had a lab. We had everything we needed. It all ran like clockwork. You could have shut your mouth, cooked, and made as much money as you ever needed. It was perfect. But no, you just had to blow it up. You and your pride and your ego. You just had to be the man. If you'd done your job, known your place, we'd all be fine right now.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks created on Friday with the Dow Jones Industrial Average plunging more than 2,200 points after China stoked trade war fears and Fed Chair Jerome Powell warned of higher inflation and slower growth stemming from tariffs. And what a crazy day. Very, very red. The S&P 500 down 6%. Brutal day, guys. We're not even going to talk about the red we saw because it was red everywhere. Look at Apple, Nvidia, AVGO, Microsoft, Google, Meta, all of the big names, hardware, software, financials, retail, manufacturing. Everywhere was red except for a couple of names right here, Nike, Lululemon. And we're going to talk about why a couple of the home builders. That was pretty much about it. Lowe's, right? Target, some of just the some of the dollar stores. That was really it. Not even the quintessential defensive sectors were green. For example, communication services, right? Look at stuff like utilities, very, very red. Today was simply a liquidation. It was the market just getting out of equities, getting out of risk assets, and not even going defensive, just holding cash, just going straight to cash. We saw mid caps, large caps, small caps, growth, value, and core all fall, and every single sector was down today. Even gold, the best performing index, right? GLD fell 2.34%. So there weren't safe havens. It was just liquidation and people wanted cash, right? And that's what we saw today. The S&P 500 down 5.85%. And it really all started after Liberation Day. If you look at the major sectors this week, again, gold outperforming, but still down 1.53% on the week. And everything was looking really rosy up until Wednesday. The market had priced in about a 10% effective tariff rate. Donald Trump came out and actually announced about a 20% effective tariff rate, and so the market has to re-rate. Now, we were down about 10% in the S&P 500 leading up into this zone right here, and we've just fallen another 10% to adjust for that extra 10% in the effective tariff rate. So the S&P 500 in these 2 days was down about 4% here from Thursday into Friday, and down about 6% here today, down about 9% for the full week. The S&P 500 was up about 1% heading into the Liberation Day announcement. The worst performing sectors being stuff like energy, right, are down 14%, but energy also has some issues with OPEC. OPEC have come out and said they are going to oversupply the market. I think they're looking at maybe putting some hurt on some of the American. We actually may see some bankruptcies in some of the energy stocks because of what OPEC has doing. So on the bright side though, energy prices are going to come down in a significant way. And we did see crude fall significantly. Tech was down double digits. Financials was down double digits. Industrials was shy of double digits. Just XLC, materials, discretionary, healthcare, they were all down. We're looking at mid to high single digits. And then we had the best performing sectors this week, XLP, XLU, down 2.43 and 4.42% respectively. Real estate was down 5.92%. Real estate being pretty resilient due to what we're seeing in rates. Yields have come down in a very significant way. And then we had healthcare. So really just like safe havens, gold, and just the defensive sectors outperformed the rest of the market, the cyclicals and the highly sensitive sectors. Guys, history is literally being made right now. These are major single day drops in the S&P 500, right? This is where we are right now, April 2024. The only time that we beat this, right, was here, March in 2020 with regards to COVID. August 2011, when we had the US credit downgrade. This was following the GFC when the market was kind of recovering. Then it was the actual GFC, right? Then it was the actual tech crash 2001, and then it was April 2000, part of that tech crash as well. So I mean, excluding 2011, it was major events. So what the market is telling you right here, that these tariffs are a huge event and it's going to have ramifications. Now, I do have some data right here. Generally speaking, after the S&P 500 has fallen more than 10% in 2 sessions within 2 months of an all-time high, what are the returns we can expect? Now, this has only ever happened in 3 separate scenarios: 1929, 1987, and 2020. And in every such cases, we look at the mean and the median return 12 months later, we're looking at 20% above the average return 6 months later, 20%. But I do want to just actually quickly just remove 1987 from the chart and 2020 from the chart. And why is that? Because when you look at 1929, this is when we actually had Smoot-Hawley tariffs come into the market or get introduced. And you could see that 12 months later, the S&P 500 was down 4.5%. We did gain 6 months later, but you can see in the very near term, 1 week, 2 week, 1 month, 2 month, and 3 month, the S&P 500 in these time periods was actually very, very negative. So guys, do expect volatility. Now, the reason why we sold off today is because China came out and imposed a 34% retaliation tariff on the US. All US goods entering China will face a 34% import tariff. Also, 11 US firms, including Stadio, Kratos, and Unreliable Entity List, China is banning them from trade and new investment in China's home country. China also placed 16 US companies such as High Point, Aero Technologies, and Cubic Corp under export controls, halting shipments of dual-use items. He also put a ban on a number of precious metals entering and exiting China and coming into China, and these measures will take effect immediately. The 34% tariff will take effect on the 10th of April. Now, why this date is incredibly interesting is simply because the 9th of April is when Liberation Day tariffs go into effect. So they're pretty much saying, hey, look, if you decrease yours because you put it on the 10th of April, we'll go ahead and look at ours. But if yours come in, ours are going in as well. So very, very interesting situation. Now, what also compounded the selling here today was actually some of the economic data we got. We actually got good economic data. For example, non-farm payrolls came in at 228,000. So what we are seeing is that the private economy, the private market is absorbing some of the additional noise and job losses we're seeing from the public sector. We can see that the consensus was 435,000. So we absolutely smashed expectations. The unemployment rate did rise to 4.2%, and average hourly earnings did come in and meet expectations of 0.3 month over month and 3.8% year over year. Participation rate was at 62.5%. Now, the reason why this compounded selling is very, very simple, because it means that the Fed are likely going to be on hold in their next meeting. They're probably not going to make any cuts. And that's exactly what Jerome Powell indicated. I'll quote directly. Now, Jerome Powell, Fed Chair, indicated that President Trump's proposed tariffs would likely increase inflation and slow economic growth, suggesting the Federal Reserve will adopt a cautious wait-and-see approach rather than cutting interest rates soon, as investors and Trump had hoped. This stands alongside a strong jobs report, but looming tariff-related price hikes has led to mixed signals for the stock market, dashing hopes of immediate rate cuts that typically boost equities, while raising recession fears as economists predicted economic strain. Powell emphasized the Fed's independence and focus on data-driven decisions despite Trump's public pressure for lower rates, highlighting a tension that could further unsettle market confidence. So long story short, you probably aren't going to see a rate cut in the next month. So right now, there's no Fed put, there's no Trump put. The market is truly on its own. And that is why you're seeing the moves we are seeing in the market right now. So let's actually talk about some market movers that were green. We're not going to talk about the red because everything was red. Bitcoin held up very, very well today. When we get on the charts, we're going to talk about why we actually expected this. This is why I have quite a number of cash secured puts for Bitcoin, and we'll be getting into a lot of Bitcoin positions at very favorable prices. Bitcoin was up 1.25%. We'll talk about it a little bit later. Nike was up 2.7%, bucking the trend. And that's because Vietnam and Cambodia, where almost 60% of Nike sources their products, are looking at a tariff-free agreement. The Secretary of the Communist Party of Vietnam told Trump's aides that Vietnam wants to cut the tariffs down to zero. We also saw a number of agreements with Argentina, with Ecuador, with a couple of other smaller countries as well. Hopefully, we get some of the major countries countries, the European Union and China, come to the table. Maybe this weekend we'll see how we go. But yeah, and Nike was up just because of that tariff-free agreement. So, Nike shareholders can breathe a little bit easier with regards to that. If we didn't get that, if Vietnam retaliated, Nike would probably be down another 15%. So Nike could be a place where you might want to actually hide capital, but I still think the stock is very, very expensive. And you could see the sentiment shift from here early in the morning pre-market into the midday end of day. Now, D.R. Horton and home builders are all gained like 3-4-5% today, and home builders rallied because yields are coming down in a very significant way. We'll look at it on the charts. Now, for everything we saw today, there were 870 advances, 5,500 decliners, mostly here in that 2 to 10% range. Very, very ugly. We saw outflows in the Nasdaq 100, the New York Stock Exchange, brutal market action, and we're looking at single digits in market momentum looking absolutely terrible. Look at this, 4% in the 5-day, 7% of stocks above their 20-day moving average. And by the way, this is the S&P 1500. It's not the S&P 500. It's mid caps, small caps, large caps. 9% of constituents above their 50-day moving average, only 12% above their 100-day. Less than 20% of stocks are above their 200-day moving average. And this number just yesterday was 28%, and just last week was 36%. So we are seeing market deterioration in breadth across the board. But let's hop on the charts. Now, guys, looking at the charts, let's actually just quickly zoom in here. Now, very, very ugly day across the board. The S&P 500, the Nasdaq 100 down 6%, the IWM, the RSP, everything was down like 5-6%. Mid caps are performing, but look, brutal day across the board. Not looking that great here in extended hours. We also saw the volatility tick up, the spot VIX at 45. Very, very crazy. Europe was down, China was down. The dollar did gain, so we could definitely see that rotation out of risk assets, even out of safe havens like gold, like silver, right, and into the dollar. That is why the dollar actually gained here today. So ultimately what we saw was a liquidation out of risk assets, out of the markets into the dollar. People wanting cash, people saying, hey, I would rather be in cash than anything else. I would rather collect my 4.5% than be in any type of risk asset. Bonds, we also see a little bit of rotation into bonds, particularly longer term yields. The TLT was up 1%. Bitcoin held up there very, very well, up 0.74% for the day. And then we saw gold and silver fall. WTI on the back of some of the OPEC news, they're going to flood the market with crude. That was announced today. So you're going to see maybe even cheaper oil prices. And I think they're trying to, in the longer term, flush out some of that excess supply by maybe bankrupting some US shale producers. We'll see if it works. I don't know what their ultimate plan is, but this is where we are right now. So let's actually look at the market as a whole. So let's actually quickly go to the SPY. We'll quickly go ahead and hit the line chart, as you can see right here. Look at the last 5 days of trade, and we'll add some of the major indices. We'll add Europe, we'll add the RSP, we'll add gold, we'll add Bitcoin. What else are we going to add? The RSP, we'll add QS, the Dow Jones, small caps, the IWM. Oh no, we already have Europe, we have the FEZ, and then the China 50 index. Yeah, great. So looking at the last 5 days of trade right here, you can see very, very ugly last week of trade. Bitcoin, the only positive risk asset. We're going to talk about why. Gold outperforming, down 2.44%. So still not even a safe haven bet. You're still looking at selling there. China down 4.46%, and then US assets and European assets anywhere from 7 to 8% drawdown this week. Now, it actually all started here on Wednesday. In fact, most of these assets are down about 10% peak to close from Wednesday. We were up about 1 to 2% leading up into the week. In fact, Bitcoin was actually up about 6% at one point. So we did see a little bit of selling in Bitcoin net from Wednesday. But yeah, it really goes to show that Liberation Day, this is when we had Liberation Day, and then the market's absolutely tanked. S&P 500 down 10% in the last few days. Looking year to date, our gold is still in double digits gains. So is Europe, or mid-single digits, I should say. China's flat, and European equities taking the brunt of the hit, down. All of them down, in excess of 10%. In some cases, double digits, and then Bitcoin also down 13% for the year so far. So absolutely brutal. If we look at the last month of trade as well, things were kind of going good up until the last couple of days, and then things just fell out of the sky. Now, having a look at the S&P 500, here is the RSIs. You can very clearly see we are in oversold conditions. So number one, after the last 2 days that we've had, if we see a little bit of a bounce on Monday, just a dead cat bounce, that would be completely normal. However, for that bounce to materialize to anything higher, to anything more, to see further upside in this market, we're going to need a rolling back of the tariffs. That could come in the form of Donald Trump just announcing, say, hey, look, we were just really, really harsh with these tariffs. Instead of 50% reciprocal tariffs, we're going to do 25% or 15%, 10%. If that happens, the market can see a little bit of upside, right? But there'll still be that uncertainty in the air. Ultimately, the best case scenario would be for Donald Trump to just cancel all of the tariffs. In that case, we probably go back to these 5,800 highs very, very quickly. I put that scenario at 2% probability, right? Right now, with where we are right now, the best case scenario can be China, Europe, and some of these major countries all come to a tariff-free agreement with the USA. If they negotiate a tariff-free agreement, right, then we can maybe see like support here at these levels while the market digests everything. I put that at probably a 5% probability. I think the Europe, much like what China did, Canada and Mexico, all of these countries probably are going to retaliate accordingly first, and then they're going to maybe come to an agreement. So we're going to see a little bit of retaliatory measures this weekend, it's particularly from Europe. That's really what I'm looking for. So look, if we get retaliatory measures or if things don't change at all, we're going to follow the trend, which is we're going to go down. If we have the other very minuscule, if we have the other options where all tariffs are canceled or they're rolled back, then we can see a little bit of upside. But even then, I think the market is probably going to be in a wait and see mode, and then we just digest everything from there. So look, I'm expecting more downside. We may have a little bit of a relief rally because we are oversold here in the S&P 500, but do expect us to hit 4,800 level as we go lower. The same with the Nasdaq 100. Very similar situation. You could see on a peak to trough drawdown, we're down 21%. Just for the record, the average drawdown in the Nasdaq 100 is about negative 24%. So it does look like the majority of the move is behind us. We can fall another 5%, don't get me wrong. And again, if we don't get an agreement this weekend and if Europe retaliate, we can definitely see more downside to the 16,600 level. Obviously, we can bounce very similar to the S&P 500. We are in oversold territory, so we can bounce and then continue the move lower. But for this bounce, again, to materialize, we'll need to see massive concessions across the board, and not just concessions from Europe or China, concessions from the US. It takes two to tango, and the US will have to come to the table. And I do think that, if Europe say, hey, we'll annex our tariffs, much of the US will say the same. But right now, I'm expecting further downside next week, and I think we should hit the lower end of these ranges unless we get some very, very positive news in the market. The RSP doesn't look that great either. I think we are probably going to go lower, and many of these other indices not looking good. Europe slipping through some of these major support levels, looking at the lower end of the range right here. So yeah, I mean, once Europe breaks some of these levels, it's like, 431, where we could see the next level of support. That being said, let's quickly look at the dollar before we wrap things up here. The dollar was actually up 0.93%, but we're very clearly in a downtrend. And I do expect us to see a 100 handle in the DXY. The 10-year yield, very similar situation. I think we're going to see 3.6% if things continue to deteriorate on the path they are right now. At 3.6% 10-year yield. We did see a huge move lower right here, a lot of volatility in yields. We'll see if we go ahead and move lower from there. Now, let's actually quickly talk about Bitcoin before we wrap things up, guys. Now, if you want to go ahead and add my FinFluential Global M2 Money Supply Indicator, offset it by 108 days, turn the Bitcoin chart into a line chart, and you can very clearly see why Bitcoin was very, very resilient, because we were actually expecting this type of move right here. Now, Bitcoin tracks the Global M2 Money Supply 1-to-1. You can see Bitcoin moves down, money supply moves down. So somewhere between late April into early May, we're looking for consolidation and a move up to retake these all-time highs. This is why I recommend that if you are looking for some form of a hedge right now, wait for Bitcoin to move lower next week, which I'm expecting, and then maybe get in because it does does look like we have a lot of support here, especially from the global M2 money supply, which filters down into Bitcoin at about a 3-month interval, a 3-month lag. So that's what I'm expecting with regards to Bitcoin. But all of these assets right here, the S&P 500, the Nasdaq 100, all of these major gauges, I am expecting quite a bit of downside unless we get a significant change in the trade policy rate. Do I think that's going to happen? I don't think so. I think, Donald Trump canceling tariffs and Europe coming to the table, China coming to the table is probably at a 2 to 5% probability. The most likely probability is Europe retaliation and us continue the selling to the downside. Again, I do think the majority of the move is behind us, but, we can see another 5% down from here. I did buy some stocks today. I bought some, I did some indexing QUAL, QSM, as well. I haven't added to my individual positions, but on Monday I will be adding to Meta. One of my biggest positions, 50% of my portfolio is in Meta. How bad was Meta today? Down 5%, brutal day. I'll also be adding to Visa as well. Come on the Monday open. Visa. Did Visa outperform the market today? Down 7%. No, it did not. It was absolutely brutal. And I will be adding to Evolution as well. Evolution AB down 4% today. So actually did outperform the S&P 500, and Evolution has acted pretty well this week. If we actually look at the last 5 days of trade, turn this into a percentage return, Evolution was actually down about 3% when the S&P 500 was down 9%. So look, we did see outperformance, but look, on a peak to trough basis, Evolution did fall 5% as well. So it definitely wasn't. It definitely did see some of the pain that the market saw. Nonetheless, guys, stocks are looking attractive. I really do think so, but do expect further downside and more volatility. And I think if you're looking for very long-term holds, 5-10 years plus, this is where you want to be adding to some of those magnificent 7 names, some of your index products, stuff like the S&P 500, the QQQs. Valuations are starting to look attractive again. And if we do get further downside, things will look very, very attractive. And I would say in this environment, continue to buy the dip for the very long term. And if you're a shorter term trader, maybe look at Bitcoin or just sit on your hands and collect that yield from your money market account. This is CNN's Fear and Greed Index, and we are officially at single digits. And the data point I saw, guys, with regards to this is whenever you bought the Fear and Greed Index, when it hit single digits, the average return 12 months later, you were looking at a 22% return in the S&P 500. It's going to be a very bumpy ride, but I do think we can get there if everything goes in the way of the bulls from here on out. That being said, we are in extreme fear, and if we do stay in this zone, that is definitely going to cause volatility in the market. And if you've been living under a rock, the reason why we've been so volatile simply has to do with tariffs. Now, for example, Donald Trump was widely expected to introduce reciprocal tariffs. Now, for example, the European Union, the market was expecting an 11% tariff rate, up from 1.2%. What did we get on Wednesday? A 20% European Union reciprocal tariff. Look at the rest of the world. We're looking at a 25% rate here, up from the expectation of 8.5% versus the 1.6% previous number. And you can see why the market has reacted so adversely. We missed very, very badly to the upside. The analysts were wrong, and now the market has to reprice accordingly. And it's doing that by selling stocks, de-risking due to the higher risk premium associated with stocks, risk assets, and the equity market. And even in China, we were expecting a very big tariff rate, and Donald Trump's reciprocal tariff beat to the upside at 34%. And this is a significant jump any which way you look at it, and it is going to affect growth. And the truth is, we are probably going to see equity markets churn and trade flat for a good 6 to 12 months. Now, we can see huge upside, we can see huge downside, but net, we're going to see flat returns. And generally, when we have a negative Q1, like we saw right now, Q2, Q3, and Q4 in the same year tend to be very, very average. So we've had a negative Q1, that very likely means we are going to have a stagnant to sideways year. In years where we have a positive Q1, we generally see returns of 9% and above. So guys, one thing you should expect in this market is volatility and a kangaroo market where we just sort of do this. Ultimately, you want to buy the lows of the market and you want to stay invested and you want to look for opportunities to get long, but it is a long road ahead and 2025 is going to be volatile. Now, here are multiple scenarios according to Cross Asset Research. Now, they have 4 different outcomes, right? They define it as a downturn, the muddle through, confidence is back, and the bubble case. Long story short, in the downturn, which seems to be the expectation the market is pricing in right now, they see the S&P 500 with an equity risk premium of 5 to 5.5 or 500 to 550. This is basis points or 5 to 5%. That would see the S&P 500 at the low end of 4,600 and 5,500 at the high end, a 3% 10-year yield, and S&P 500 earnings per share at 230. Now, for 2024, we reported earnings per share of about $248. All right. Expectations into 2025 was for about $270. So we are seeing a decline from 2024 levels and a significant decrease from the expectation of Wall Street coming into 2025 of 270. Now, the base case sees a tiny bit of earnings growth, a 3.75% 10-year yield, and the S&P 500 between 5,000 to 6,000. Now, giving a 1,000 point range is really, really broad, but call it the middle and call it 5,500. And that is where we are right now. They see this as the end of year price target. And that's how we sort of get that sideways price momentum we were talking previously. So if you see a tiny bit of earnings growth, 1 to 2%, and a 10-year at 3.75%, and we are currently at 3.975%, we get that. You sort of see this sideways market, which could see 6,000 at the very top end. In a situation where we clear a lot of the hurdles, confidence comes back into the market, right? We get a 10-year yield at 4.5%. S&P 500 earnings at consensus 270. We get a 5,500 to 667.50 S&P 500. I don't think that's possible in the here and now, especially if countries retaliate and we get into a deep embedded trade war. I think confidence is back is everybody folds. Countries fold, the US folds, and we get a free trade agreement. And in the case of a bubble, I don't know, we're not even going to talk about this because this is not even possible in 2025. So this right here is like the absolute bullish scenario. And even at the low end, we're looking at 5,500. The muddle through is if things go the way of the bulls, maybe we get here. The likely scenario as the market is pricing in right now is this right here. So it does mean we do get a little bit of downside if we get to the middle end of the range, maybe 53, 5,200, but probably flat returns if we look at the high end. And again, you're looking at a 5 to 5.5% equity risk premium. That's a lot. In all of the other instances, we're looking at a much lower ERP. But let's talk about the macro. Let's talk about everything as it pertains to the macro. Now, these are the effects of tariffs on real GDP growth for 2025. Now, the main one we are concerned with is the United States. The current tariff implementation will see GDP growth decrease on a year-over-year basis of 1.2%, difference from the base case. So the base case in the United States right now is 1.7%. You remove 1.2% and you're looking at a 0.5% GDP growth. So slight growth for the United States. The rest of the world kind of hanging in there, but definitely tariffs will impact these countries, Germany, Japan, South Korea, Taiwan, Ireland. Tariffs will impact the growth rate of these countries quite tangibly. And this is why we're starting to see slower growth in the global US market, or expected slower growth. At the same time, Barclays has revised its inflation forecast up after tariffs and expects GDP decline. We're going to go ahead and read. New reciprocal tariffs announced by Trump levied on imports from almost all US trade partners increase the risk of a recession and will lead to higher inflation. President Trump's long-awaited reciprocal tariff announcement suggests an increase in trade-weighted tariff rates to about 23%. Barclays analyst said in Economics Research Note on Thursday, "We remain uncertain where the new trade-weighted tariff rate will settle," the analyst wrote, but said that based on average tariff rate of 23%, they revised their forecast to now project core inflation measured by the CPI may reach 4.1% this year. It's currently sitting at about 2.9% at the current moment. This is up from their previous core CPI forecast of 3.6% for 2025. So we're seeing inflation numbers going up. The analyst also said that they now expect real gross domestic product in the US will decrease 0.1% this year, and that unemployment rate may rise to 4.6% by the fourth quarter. So when you have slowing growth, the unemployment ticking up and higher inflation, that is a stagflationary environment, coupled with the fact we are starting to see unemployment numbers really fluctuate to the downside. US challenger job cuts saw a huge beat, mostly led by government employees losing their jobs, 270,000, I believe, against a consensus of about 250,000. This is the type of environment that really can cause a recession. When you have prices rising, people losing their jobs, inflation ticking up, that is a recipe for poor equity market returns and just an overall weak economy. Now let's look at the data, guys, for next week. There isn't really much of anything here on Tuesday. On Wednesday, the big thing is going to be the FOMC minutes, but we kind of know what we're already going to get. It's not as much of a market mover as it used to be. Now, looking at Thursday right here on April, we actually do get the core inflation rate month over month, and then we also get the headline inflation rates. So the CPI numbers are going to be big. We also get initial jobless claims, and then on Friday, we get the PPI numbers, core PPI, and headline PPI, as well as the Michigan consumer sentiment. And then earnings next week is actually kind of big. We kick off Q1 earnings. We have some of the big financials and banks reporting, the biggest being JP Morgan, Wells Fargo, Morgan Stanley. They're all going to be reporting towards the end of the week. PGR, Progressive Insurance, BlackRock as well, the Bank of New York Mellon, Fastenal, Delta, RPM International, CarMax, Levi Strauss, a couple of other big names right here. But all in all, we're back into earnings season Q1. And then in a couple of weeks after this earnings week, guys, we get the big tech earnings. But everything, all of the focus is not going to be on the quarter that was, because I think this quarter might actually be pretty good. We're looking anywhere, I would say 7 to 8% earnings growth, 4 to 5% revenue growth. The big question is going to be on guidance and what the market is looking for. And I think we're going to see a lot of guidance suspensions. You know, some of these big banks saying, hey, we don't know what to expect in this environment, so we're not giving guidance. And that's just going to create even more uncertainty. And it's this wheel where uncertainty breeds uncertainty until things come full circle and we meet in the middle, or I should say Donald Trump and all these countries meet in the middle. But nonetheless, guys, expect volatility and expect the unexpected. That is the best way to deal with everything going on right now. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.